Hello ladies and gentlemen, I'm Joseph Novichkov, Senior Trading Manager with GDM. Welcome to today's webinar. In today's system, we will have a look at another 1-hour chart trading system. As you can see in front of you right now, we have already set up Euro-Dollar chart, 1-hour time frame. Before proceeding to today's system, I would like to make a few amendments on the last strategy that we spoke about. Simply what you see here for those particular series of webinars, as per request from most of our clients, they wanted something a little bit more simple, something that does not involve too many indicators, too many confirmational points, should I put it this way. This is one of the reasons why we've decided for the past 2 months, this is the second one, to present something new, something more simplified, that it's much better to use. Well, depending on what I mean better, I mean much easier to understand in order to make the right decision on the market. Simply, a few of the previous strategies, they were a little bit too advanced for the majority of the traders here. So we actually left those particular systems for one-on-one sessions for somebody that needs a little bit complex system, something that has more indicators, something that gives you higher certainty entries for bigger profits, daily, weekly basis technical systems, so on and so forth. As well as the one that you saw the last time. It's formulated by those particular indicators that only the MetaTrader 4 supplies with. Of course, that doesn't mean that any other platform that you might be using at this stage is not supporting them. I mean that some of them might be missing in the platforms that you are using. For those that are using something else, you know, other different brokers or any kind of web versions of different types of trading platforms. So forth, for those that are trading with us, you are already familiar with this way of scheduling those O sessions. Also, you are already familiar with the system of correspondence and so on. Also, I would like to mention our email address. It's webinars@gdmfx.com. For those that are not in our company. Also, in addition, you can use directly from our website, down on the right corner, you will find directly the chat to our support department, or you can always give us a call at the office directly. And of course, you will be able to find me or any other of my colleagues, preferably depending on your requests. So getting back to our system today, we will be only using 2 particular indicators. Of course, the setup is a little bit more different than we've been using this particular type of system in our earlier teachings, in our basic training webinars. But before getting in depth into the system itself, I would like to mention that during that time, I will also monitor the news that are coming out from US and Europe as well, because in the next 25 minutes we will have durable goods orders and the Eurogroup meeting. A lot of things will be decided in about 25 minutes. First, durable goods orders will somehow point towards what direction the Federal Reserve will take their next week's meeting, whether they're going to be more dovish rather than hawkish against the interest rates. And I believe all of you guys are already monitoring all of the development around the US. The recent numbers that we were getting this week, last week, and you're pretty much well familiar at what exactly that you need to see in today's data, so we can pinpoint on a timing of an interest rate increase, which is by far the most important in our trading. As far as the major commodities and currency pairs connected to the USD, everything will have impact on that. So far, getting back to our system, today's trading system will use a bit of a cleaner chart than we've been using the last time. This particular system focuses on Fibonacci retracement and stochastic oscillator. The Fibonacci stochastic system is quite simple on a setup, but of course quite effective on based on our past exams of this particular system. It's been tested for the past 7 months now. It's been working quite well. Of course, we've made a little bit of changes from the original system itself due to parameters, so we can correspond well in one timeline. Also, a few of the exceptions and the rules were also amended. So right now, what you will see is the finished product, something that you can well enough incorporate into your daily trading. The first thing is to, of course, set our Fibonacci levels from low to high of the previous trading day. Also to add the stochastic oscillator with the appropriate period and levels on the chart. And of course, there are a few things that we won't need. So right now, I will set up the stochastic oscillator first before I move to anything else that is, should we say, more relevant. So for the stochastic, you can see the parameters that I'm using for the D and K percentage periods is 14 and 13. And for the slowing moving average, we'll be using 3. However, here on the colors, what we will not need is the main oscillator. We're not really going to need it. So the one we will need is the signal line only. That's why in order to get the main hidden, in order to filter all false signals, we have to choose a color that it's very close or the same as our background. So right now I will only apply it and then go back to it with the color of my background. We'll copy it from the properties of the platform, and I will go back to the main, and I will just hide the color in the main line along with the background, so we can only leave the main signal, the signal line. As levels, we will see, we will just remain with the default levels. Some cases we're using 30 and 70 levels. That was the first idea, but it didn't really correspond well along with the Fibonacci trigger levels. Basically, it was giving a few false signals on a break-off. So I will show you later what I mean. Let's simply apply. This is our stochastic here. So right now I'm going to need my background levels. So I'm just going to copy it from here. I'll just go back to my stochastic and fix this color here again so I can hide it. And this is what we have. It's just the red line, the signal line on our stochastic. It's a bit better. It looks much nicer. Now, there were questions before. I will answer to this straight away because I know that those kind of questions will pop out. It's been the same for the past few months. Questions about why I'm using the stochastic instead of the relative strength index in case of using only one line. Well, it's very simple. What the stochastic is actually calculating is far different than what the relative strength index is actually measuring and calculating. And the stochastic is a bit more slower than the relative strength, so it corresponds well, much better with this system. Another thing that we will need is the period separators, something that I will straight away just set up into the chart. So I'm going to show up the period separators. As you can see, this is a 1 hour chart. Mainly what I'm focusing on with this strategy is to see where the previous day price actually closed. We can always choose daily chart to see that in a better picture, but it's quite easy to see what was the highest and lowest level of previous day. So it's pretty much focusing on a break off of highest and lowest of the previous session close and open. But that's not the main thing. We're of course using the Fibonacci, but we're actually measuring the previous day high and low levels. All right. Now, as you can see, just in front of you, this is the by far the end of everything, and the price is developing right here. So we're going to work with this, with what we have right now. We're going to use Fibonacci retracement levels as by far the default levels of the Fibonacci. So let's pick a time frame. Okay, let's say this one here or this one here. Okay, the start of the week. Okay, from the beginning of the week, and this is today. This is Friday. So we have the highest level is quite obvious. It's the open, and the lowest is by far this one here. Now, what this system focuses is on a continuation of a trend. So we can't really use the Fibonacci by the standard way. Instead, we're going to reverse the Fibonacci and use the levels upside down. This is the only way we can properly measure a continuation of a trend and properly set up our take profits. This is the main thing that we're looking for. The stop losses, we will speak about that later on, as also an integral part of everyone's trading. But what I like to do here is, especially on a sideways range, because you had a sideways range previous day here. So let's take that as an example. This is something that we will talk about, but I will actually leave it for last. Let's focus on the Fibonacci in a directional trend before we move to the sideways. So we're using the Fibonacci, as we know that it's a downtrend here for this particular day. The lowest point was here. So we're dragging the Fibonacci up to the highest point, and what we're getting is actually the levels spreading in the direction of the previous trend. So our goal here is to look for a break-off in the same direction of our previous levels. And this particular system is very suitable for pending orders as well as market execution orders, but pending orders are very good for this particular system. Market execution are mostly used as a conservative type of trader, which I will move forward to as well in the next following minutes. Right now I would like to focus on the more of the risky type of trader that this particular system is going to generate you higher profit for a very small amount of time, because the conservative type of way will generate less profit because you're waiting for a confirmation, for a better confirmation. What kind of confirmation you will be waiting for as a conservative type of trader, I will let you know in a couple of minutes. But the most proper way, the way I've seen this particular system making less mistakes and higher profits, is pretty much the aggressive type of way. But that doesn't mean necessarily that very often your stop loss will be hit. And that's why The conservative and the aggressive type of trader, they have different type of setup on the stop losses. So we will speak about that later on. This is one of the ways that we can minimize our losses and expand our profits. So as a technical point of view, we're waiting for a break-off. Let me put an arrow here. We're waiting for a break-off down below the 100 level. Okay, we have a directional trend from the previous day. Let's follow the whole system once more. We had a directional trend on the previous day. Okay, then we're expecting the new day to continue to the downside, and from where we need to have a break-off, and this is our 100% retracement level, which of course we're using backwards, so we're measuring the continuation, and our continuation actually on the Fibonacci gives us specified targets. Specific targets as 161.8 level, or shortly 161 and 261. But in most cases, those aggressive type of levels are not well made. So I usually set up two targets, one in between and one at the target as well. So you're booking your profit half the way through, and you're booking your full profit at the first target as well. Because in the majority of cases, especially on high volatile pairs or commodities, you will very often see once that the level is reached, then you have a retracement at least 50% of those levels, 100 and 161 too. So 50% retracement of this level you will have for sure. So that's about 30 pips, all right? So when you have that 50% retracement on this level, so when the price gets someplace in the middle, you can short one more time with first target here, 30 pips down, and a second target in between, plus a third target down here on the 261. This is the best way of taking your profits. Now that's the more aggressive approach when you're only looking at the Fibonacci retracement, all right? But that's why we need our stochastic oscillator. We need a second confirmation of whether the price is actually going down and it's not actually giving us a false signal. This is a break of 20 or 80 level of the stochastic. When I'm saying a break, most of you or some, or just some of you might be already familiar that stochastic and relative strength, they're measuring overbought and oversold conditions, all right? That means in a directional trend, particular indicators like this one do you no good. So they're only a confirmation that you have a direction, and this is why I'm using it. For some of you might say, okay, why would I want to use that when I have moving averages? Well, we already spoke about the moving averages yesterday, so if that's much more suitable for you, you can use that as well. Not yesterday, but make a correction on Wednesday, the day before. So let's have a look. What happens in this particular case here when the price is breaking in, and why we should have a pending order in cases like this one. We'll have just a horizontal. Here we go. We have a break off a little bit earlier on the previous candle, telling us the market is up to a breakthrough, the level of 100. And we have a clear breakthrough plus below level of 20 on the stochastic on the next candle. But this is a candlestick of a maximum of about 50 pips of difference. Now that's a very big move for this kind of candle, on this kind of chart like 1 hour chart. So cases like this, not being an aggressive type of trader with this system will pretty much limit your profits on a daily to weekly basis. So that's why this particular system is more suitable for pending orders and much more aggressive approach, because it's focusing on a break-off of a support and resistance level represented by 0 and 100 on the Fibonacci. So if we have, for example, a pending order somewhere here, just a few pips below this 100 level. Sorry, I'm using a trend line only to set up some kind of a level here, so I'm actually going to change a little bit of the color here so we can much better see what is happening. So below this green level here, the price here is 1.07068. Okay, this is just an example how you can set it up just a few pips below this. And I'm saying just a few pips, that's about 4 to 5 pips. This is the rule. It's much better to make it on a 5 pips level, all right? It's very common that the price makes a break off with 1-2 pips and it doesn't continue to the downside. But if it makes a move with more than 5 pips, 5 up to 10 pips, that will definitely tell you that the market will continue this way. This is another type of calculation of a market breakthrough, price continuation, and support and resistance levels. Those are systems that we spoke in our basic webinars trainings. So if you are more interested to find out on why this is looking exactly why you see it in front of you, it's basically it's following the rules of break off through support and resistance levels. And as you can see, the Fibonacci retracement is focusing on support and resistance levels. This is pretty much the retracement level, so you can expect the price to make changes. So once it gets to a level of, doesn't matter if it's 61, 50, 38, it stops, comes back down, then it goes back up, breaks the next one, then it comes back down, then it breaks the next one. This is the way the trend is sustained. But if you have a very strong, powerful momentum candlestick, that definitely means that this particular shot is not going to be sustained, and you will have more than 50 to 66, sometimes in most cases up to 100% retracement in the near term. So on the chart that you're looking at, the larger the candlestick, the larger the chance that it will retrace sooner rather than later. And this is what it actually happens. That's why I would like to have my take profits someplace in the middle between 100. Then we have the next level here, which is somewhere around the 130 level if you wish to customize your Fibonacci and to have more lines on it. I particularly don't think that's necessary. It's quite easy to measure what's the difference between one and the other and just set up a take profit level. So we have about 65 pips from one line to another, and if you divide it on 2, you will get the 32.5 pip. When you get rid of the spread that you're getting and the open price pips, you will get about 30 pips of clean profit for about 15, maybe, let's put it 1 hour. Okay, 1 hour. For 1 hour, you're making $300, and that's not only the thing. You might be able to have further opportunities to go the same direction, same like this one here. You have a strong white candlestick, but that doesn't mean that you wouldn't short when the price is at the 100, where you can see that it's reaching there, and then it's bouncing down to this point. So you've got one more take profit in the next few hours. So for one day, if you manage to get $300 to $600 on one lot traded, which means that if your balance is bigger, you might be able to get 5,000 to 6,000 each day, which is a pretty good profit. On from where you take take a look at it, it's still a good profit. What I'm trying to eye here is pretty much the continuation of this particular trend, but as well as we're looking at a 1 hour chart. Now this is the other section of the system where I actually had to customize it and to change a few details when I was using it along the way for the past 7 months when it's been tested. Then I had to add additional tools in order to get the full of it, the whole thing about this system. So you're drawing it in the morning and you just wait, put a few pending orders and then you just wait for everything to be hit. Basically, that's the way it does. But we will speak about the pending orders and their validity in the future. Right now, I would like to focus on trend reversal. So we're looking at a 1-hour chart. Okay, we have a very short-term trend to the downside, but when this trend exhausts its power, of course, it's quite common for you to understand that the market will go to a sideways range and then probably either reverse or continue. Of course, the rule of the trend is that it's more likely to continue instead of reverse, but the word more likely leaves a few doors there to let you know that in some cases, like 10-20% of the cases, you will have a trend reversal. So we cannot rule out all of these possibilities on the market. That's why we need levels to the upside, pretty much the same ones. So what we do is we use another Fibonacci retracement level, and this time the right way. So we're actually opening another bracket here, and we have two 100 levels. You can see one here and one here. All right. I believe you are already seeing the whole situation here. So once you do this, you might not even need to change it for the next days to come, especially when the market is in a sideways range. Everyone probably has already an idea about the sideways range. You have the levels inside the Fibonacci, which are, of course, once you have 50 here, then you have 38, and then you have 61, two 23s, two 100s, two 160s, and two 260s. So for me personally, it's just a beautiful setup, especially when you're looking at a sideways range and you're just waiting for your orders to be executed. That means you will need to have another, just a few, 5-10 pips above the 100 level on the upside this time, so you can wait for a break of this level. This particular way that you're looking at the market right now, this is very common that you're seeing it. You get your break off and then the market retraces back in. But then you can see that the market is actually closing pretty much higher than the previous open. You can see it closes 134 pips higher than the opening. And now that's a clear indication that the market will push to the upside on the next day. So you're not really touching those positions that you already have. You have to leave them on. And you can see that the next day, price goes exactly at the 161. But before that, you have 2 times the hit. Okay, I can see that the market is now pushing up. I will make a small break here, only to give you the last news that's coming out right now. We're looking at a durable goods orders index, 4% increase from the previous of minus 1.4%. That means it's actually way higher by 3.4% higher than expected. So what we're seeing right now is just the market trying to get its way. Right now the price is pushing up, as you can see, but the whole durable goods orders are actually going to push the price down. And that, of course, is not the only thing. We're looking at the euro right now. The dollar will, of course, get a boost, but that doesn't necessarily mean that the euro will fall. All right, because the euro might be stronger than the dollar at this moment when we're actually having the Euro Group meeting. We have the Euro Group at this moment. We can see that they've actually started the press conference. It's not the press conference, but they're meeting. So we will be following the market throughout the day to have some additional clues for you guys. For those that are already trading with us, we're usually dispatching those trading technical analysis, and some of you guys might call them signals, where to enter, where to exit, and more in-depth technical analysis. So for those that are with us trading right now, that they have accounts with us, that definitely means that you're already receiving it. So expect in the next 1 hour time, after the webinar is concluded, for the trading technical analysis that I will send you on major currency pairs and commodities. You will have additional information in it of what's been the decision concerning Greece. This will be a major impact on the euro. Of course, what we see right now is a little bit of movement on the dollar against other currencies that are, of course, weaker than the dollar on today's basis. And all of that information you will get in about an hour time in your emails. Once the market has cooled down, everything will come in place and you will receive the full technical perspective on the US session outlook. So far, what we've been talking about is the 100 levels and their breakoff. As you can see here, the market is doing exactly what it needs to be done. It retraces on a mathematical level a certain percentage only to sustain its trend in the short to mid-term, as well as we're looking at a short-term time frames, 1 hour. And the retracement level has not necessary to be 23.6%, but it can always be somewhere around the 38 level, which definitely means that the trend is sustained. And there comes our stop loss levels. On stop loss levels, now we're talking about a conservative and a risky type of trader. The conservative type of trader will wait for this particular system to confirm itself. As you can see, we have a break off on the 100 level here. Once we have a retracement to 23, that means the trend is sustained, and then we have another break off with a very strong, powerful candlestick confirming the upside. But still, in cases like this one, how is a market execution order going to be executed? You know, of course, if you're very fast on the button, you will pretty much get the whole movement. But if you're just you know, slower with just a few seconds, or you miss the chance by looking at the TV screen at the moment when the market is actually moving, you will miss the opportunity to get in. So that's why, if you are a conservative one, and if you're waiting for another confirmation, a bounce off of these levels of the Fibonacci, you definitely should set up your stop loss by far between the 61 or some very few slight pips below the 50% of the Fibonacci. That's why your stop loss has to be closer to your entry. The closer the better. That's something for you to decide. It really depends on your risk management system, the equity that you have at this moment, the percentage that you've already calculated, what's the highest amount of money that you allow yourself to lose in one position or in total positions, or what's the whole, whether you're actually using 2-to-1 method as we've been talking about for the past few webinars. As you can see, there's probably some good news here. The euro is trying to push up. For me, this is just technical retracement, trying to break the 161 level as in terms in technical levels. But of course, we never know. I'm reading here in throughout the statements that there is something like a possibility for a Greek crisis solvement. So we might be getting in a good track on the euro, which means in this case the euro might be getting a bit of a higher boost than the dollar from the news. But that doesn't necessarily mean that it's going to be a higher volatility. It could be just a choppy market because the two currencies are too strong one to another, leading to a sideways market. This you will get later in the day in our analysis. The risky type of stop loss. The riskier trader, as well as we're focusing on something different than the 2-to-1 profit-loss ratio, riskier type of trader tends to set up his stop loss below the other 100 level. Because in cases like this one, you can see that the market is hovering throughout one break off, one target is hit, you're waiting for the second one, but your stop loss is way up here. So you have nothing to worry about. The market tries to push up one time, no luck. Second time, a bit higher, but not sustained. And then it just comes back down to your second target, leaving you with the same amount of profit that you've actually started here. And that's on the third day of the trading, which means that if this level is not broken half the way through between 100 and 161, that means that the market will try to push higher again, as well as we can see it here. So once your first target is once more hit, it's much better to exit the market instead of just letting it go for a higher target, for a bigger profit, which might not come eventually in the near term. Another way of the risk trader to set up is once one of the targets are hit, you're moving your stop loss at your entry level. This is by far the most famous way of stop loss take profit ratio setup. Me personally, I would very much like to leave it up here. It's a long way to go. Now, if the price is here, and even if it retraces from this level to this level, that's about 100 pips range. So I'm pretty sure that within the day, that stop loss will be intact. But I know that if this level, once appeared as a support level, is not broken with at least one more attempt, that definitely means that the market will reverse and will hit your stop loss eventually, as well as you can see here. Now, if your stop loss is a few pips up there, it will be definitely hit. You can see those two candlesticks, two mean candlesticks, just hovering around the above the 100 level, and then retracing with just a few tenths of pips. That's 25 pips nearly here. Retracement, quite sustainable for an uptrend. Let's have a look at this particular sideways range here. Now, if you had this set up before, if the market was here and you had no idea what's going on or where the market will actually eventually try to get, you have your previous day high and low. You're setting it up, one this way, another one this way, and you know, on a break off, you trade the market. But when this day is over and you move to this point here, so from now on, you have no idea where the market is going. You always measure the high and the lowest level. The highest is here, up to this point here, down to this point, and from this one, like this. So now you have a bit of a messy chart with all those lines, but those that are important are the two 100 levels here and here. Now, why this 100 level comes at this point? Because this is your high to low on your previous day. So when the day is opening, you have to make from the opening to the lowest point and from the lowest to the highest. This is how you will get a better execution on your orders. And you can pretty much see that on the next day. From the highest point here, the market retraces back down, developing a new trend. Or you can simply use an equidistant channel to measure high and lower point from here to here. But then you will get a bit of a wider range from where you're not getting a break off anytime sooner. So you might need just to wait a couple of days until this breakover is break-off will occur, of course. But this is just something for you to consider that you might be using. I particularly do not trade sideways range with this system. Only directional break-off trends. So I need to have a directional from the previous day, high and low, to get a clear idea of my two 100 levels. One to the upside and one to the downside in case the trend reverses. That's why you need those two Fibonacci, one reversed and one the right way of used. This is about that. Nothing complicated. The only thing you have to remember is that you need to find out first which trader you will be when you're using this system. Does your equity actually allows you to be aggressive, or it allows you to be conservative? So this is those are the two questions that you need to ask yourself once you start using it. And one more time, if you need any help to identify what particular trader you are, you know already how to find us. GDMFX.com is the website, and webinars@gdmfx.com is the email that you can directly request a phone call with me or any of my colleagues so we can get back to you and clarify your trading. That's what we do. We're doing everything to help you out and to make you a profitable traders. That's all for today. Thank you very much for joining us in this webinar. Next week, Wednesday, is the last webinar from this month, and we will be talking about any time frame trading system for any time frame and for any currency pair or commodity. The one thing that we're actually focusing on here is that it is suitable for all time frames. The only difference is that you will get reversals on a short period much more often, and then the the exceptions of this strategy are a bit more different than those on larger time frames, such as 1 hour, 4 hour daily chart. So until then, we will meet on the next webinar with any time frame trading system. It was a pleasure for presenting this one to you. See you next time. Bye-bye.